Hi, and welcome to your weekly macro roundup, where we talk macro, try to make sense of markets that don't really make any sense except on days where treasury yields are down, and answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today because we're going to find out today that the U.S. economy is in much worse shape than you actually think. Let's get right into the data and see what's going on. Back to Wednesday night, South Korean GDP on a year-over-year basis missed expectations and went from minus 1.4% in the first quarter to minus 2.9% on a preliminary basis. Very interesting stuff as we move into Thursday, and then Thursday night and Friday morning with the PMI data is really telling us a lot what's going on in the global economy. Let's get right to the initial jobless claims. Missed expectations of a 1.3 million print and came out at 1.416 million, as big friend of the show Chris Dark said on Twitter, due to seasonal adjustments turning the tide and moving the other direction, causing the number to go up. Continuing jobless claims did slide from about a little over a million, from 17.3 to 16.2 million. A good sign, except when you factor all the other forms of unemployment, we're still around somewhere like 31.8 million Americans on some form of unemployment insurance. That's just not good, especially now with that $600 weekly unemployment benefit for most people gone and the PPP loan money starting to dry up early next month. Things could potentially get pretty ugly fast. The 4-week moving average of jobless claims did slide slightly to 1.36 million. Looking into the U.S. leading index on a month-over-month basis, increased 2% in June. Kind of showing some life coming back to the U.S. economy, but nothing major there. I didn't really look at the Kansas City Fed data, so we'll kind of pass over that because we've got the preliminary market data, which is more interesting to me. New Zealand, let's see, nothing of interest. Australia, manufacturing PMI on a preliminary basis, slight expansion. Services PMI looks like a pretty sizable expansion. I mean, at 58, that's saying, hey, expanded in the services sector. But before you get excited about what's going on in Australia, you got to remember their services sector was pretty much destroyed back in April. And then in May, further contracted at a pretty large level. So the fact that it improved means it expanded from an extremely low level. It doesn't mean it's anywhere back near where it was before. It's just showing some life is coming back, but it is not showing that the service sector in Australia is anywhere near where it was before. Let's move into Friday's data, see what we've got here. Into more of the PMI data, which is very, very interesting to me. Let's look at the composite. A composite is a blend of the manufacturing and services. In France, things are getting, I don't know what's going on in France, but their data seems to be among the best in the Eurozone. Their composite PMI, according to market, increased from a 51 last month to 57.6. Looking at the German composite, back into expansion from slight contraction the prior month, now at 55.5. So again, we're starting to see some data that's suggesting in the Eurozone there is some growth going on. But we kind of know that based on what we've heard going on in Europe. But let's look at the broad Eurozone composite PMI in July on a preliminary basis, went from slight contraction to, just better than slight expansion. But when we zoom in, you can see this thing was just absolutely destroyed back in May, and then in June it was another contraction. So the fact that we're getting a better than slight expansion tells you that things in the Eurozone nowhere near back to normal. I mean, even as the economy starts to reopen and get on its feet, it's in bad shape. Looking at Great Britain composite PMI, decent expansion now at 57 from a slight contraction. But again, the details are telling us that things were so bad that these recent reports aren't even close to back to normal. They're just saying that the body is getting up off the ground after being knocked down. I mean, it's just starting to lift itself up. It's just bad shape. How about the U.S.? Everyone was expecting a V-shaped recovery in the U.S., expecting massive growth. The manufacturing PMI preliminary data as of July for market came in prior month, very, very, very slight contraction, essentially no change last month, 51.3, telling you pretty much no change in the manufacturing sector for July. That's bad. How about the services PMI out of the United States? Slight contraction last month, 49.6, telling you virtually no change from last month, and bringing the composite PMI on a preliminary basis from 47.9 in the prior month, which is a very, very slight contraction, to 50, which is saying no expansion, no contraction, no change from last month, no V-shaped recovery in the U.S., not even close. This is not good as the case counts can start to rise again, suggesting that the fall is going to be pretty bad for the United States. You know, and I've said and been on record that if there isn't a summer travel season or summer driving season, the rest of the year for the United States and potentially the rest of the world is going to be pretty bad. And the data right now is telling you, yeah, the economy is flatlining. And if it doesn't grow when it flatlines, that means it's rolling over, and you got it. And it's bearish for the U.S. economy. Not good. Of course, the bond market is telling us that already, but we'll get into that in a little bit. New home sales continue to rise on a month-over-month basis at 13.8%. Keep in mind, new home sales do not mean all of these homes closed escrow. It also counts if you put a deposit down. So we're definitely see back-to-back months of people out buying, or at least putting deposits down as well on new homes. So there's life in the new home market, but perhaps not the rest of the U.S. economy. Let's get into the H.H data. And what's really interesting about the H.8 data is it pretty much tells you things are flatline. There is no growth in the U.S. economy. It's telling us that market composite PMI data is absolutely correct. Should we take a look? It's not pretty. All right, the first up, let's see what the banks are doing. Treasury and agency securities. Well, they bought, look at that, 38 billion last week. Incredible number considering they sold 4 billion of US Treasury securities to buy almost over 40 billion, I think about 42 billion of mortgage-backed securities. Let's put this in perspective. In 1 week, the large commercial banks bought, let's say, 42 billion of mortgage-backed securities. The Fed buys 40 billion of them a month. Now, what is this telling you from a macro perspective? Are the banks like, we're short a bunch of mortgage-backed securities, we better go load them up before we can't get them? No, they're telling you that things are about to get really ugly. Remember, somewhere around 25 to 30% of people aren't making their mortgage payments. The banks are concerned. Why would they start loading up on mortgage-backed securities all of a sudden? Because they're going to flip them to the Fed. Banks already know what's coming. Remember, don't listen to the bank CEOs. You know, sometimes I get emails or questions like, hey, Jamie Dimon or so-and-so CEO of such a bank, and says, look, I don't care what they say. Look at the H.8. It tells you what they're doing. Look at their feet, not their jawbone. Let's go back to the data. Moving down to loans and leases and bank credit. No change. None. So no loan growth. You want to know if the economy is expanding or contracting? You can see it in the lending data. How about commercial industrial lending? Down 2 billion. Again, nothing going on. Real estate loans down about 3 billion. Nothing going on there. Residential real estate loans down 4 billion. The only thing that seemed to grow somewhere, I don't know where it is in here, but something went up, but not much. How about consumer loans? There you go. Hey, about $1 billion in consumer lending growth. Remember, we are in July. We should see a rebound in the consumer. It should be here. We should see it. Nothing. No sign of the consumer at all. How about credit cards? Down $1 billion. And let's see, automobile loans, flat. This is not a good sign for what's going on in the U.S. economy. All right, let's get over to the PowerPoints. Take a look at the M2 money supply, the 12-month rate of change is still rising, although slowing. It's still rising at 24.08%. The 6-month rate of change is at 19.3 and rising, but the 3-month rate of change is rapidly rolling over and down to 7.75% and falling. I mean, these numbers are off the charts, but it's mainly because consumers are holding on to money. The monetary base was unchanged, and that means the money multiplier, due to some revisions in the M2, is not up as much, but the trend is up. It's up to 3.85. It's down slightly from last week, but due to revisions, this is actually up. Now, the money multiplier is, I changed this to say this is an indicator of inflation. What I want to do is take a look at the money multiplier. And here we go. Because it can be an indicator. It doesn't mean it is. Because what is a money multiplier? It is the M2 divided by the monetary base. Now, we know the monetary base is pulled back and it's brought the dollar down with it. We talked about that on Wednesday, that for some bizarre reason in the monetary world, when the Fed buys up more U.S. Treasuries and mortgage-backed securities to quantitative easing, it is bullish for the dollar. So here, I want you to think about that. How is QE adding liquidity when it tightens financial conditions? Because a rising fiat currency tells you financial conditions are tightening. Yet, when the balance sheet gets smaller, not due to the Fed's direct actions, but due to swap lines and repo loans getting paid off, the dollar falls in value. So what does it tell you? The Fed is doing the exact opposite of what they're going to need to do. They're continuing to do quantitative easing. It's going to send the dollar higher. It is bullish for the dollar, even though right now pretty much everybody on the planet is bearish on the US dollar. So what does that mean to the money multiplier? Well, the M2 is showing a lot of money piling up into savings. Now, savings is future spending. Makes perfect sense. So if I save up for vacation and go on for vacation, when I spend that money on vacation, it's inflationary, it goes out in the real economy. So when people see a rising M2, they're really bullish about inflation and they really think interest rates are going up. They also think stock prices are going up because they think it's great for the economy. It's not necessarily always correct. You have to ask, where is the money going to go? Is it going to go into discretionary spending? Or what? Well, with so many people not making payments on loans because they're all in deferment, and unemployment benefits about to shrink to less than what people were making before, eventually those loan payments are going to have to be made. I mean, the forbearances are not indefinite. They're coming back in the months to come. That money in the M2 is only inflationary if it goes out into the real economy. If it's used to pay on debt and used for living expenses, it's not inflationary. So when we look at the money multiplier, a rising money multiplier suggests inflation. It doesn't mean there's inflation. So when we look at this chart, I overlaid 30-year Treasury yields. If we go back to late 2007, you can see the money multiplier was rising, suggesting inflation was coming, and Treasury yields, 30-year yields, were falling, suggesting financial conditions were tightening and yields were right. And usually yields are more right than wrong. And what do we see now? If we go back to 2018, we see money multiplier rising, saying inflation is coming, Treasury yields start falling, and the money multiplier gets pulled down. Treasury yields are still falling. The money multiplier is rising. What does that imply? Well, the yields are going to be right. Yields are telling us financial conditions are tightening. The money multiplier is saying we could see inflation if the money comes out into discretionary spending. If it doesn't, or we see the Fed increase its QE purchases, highly likely, or a combination of both, where we see M2 go into debt payments and the Fed easing, that means the money multiplier is coming crashing down, as I expect it will, just like it did in the great financial crisis. All right, back to the PowerPoints. Wherever they went, there they are. Real estate loan growth. You want to know why the banks are buying mortgage-backed securities? We just broke back below 4%, down to 3.94 from a year ago. Look at this. 6-month rate of change is now falling, 1.26. 3-month rate of change is effectively at 0. Record low interest rates, no real estate loan growth. Tells you real interest rates are still too high. How about commercial industrial lending? On a year-over-year basis, the growth rate's down to 20.4%, still astronomically high, but not due to being bullish on the economy, but due to needing to borrow money to keep businesses open. The 6-month rate of change is down to 19.87 and falling. 3-month rate of change is now negative at minus 5.62. This is bad. I mean, when you see a 3-month rate of change negative, you're usually in a recession. That's what this has meant historically. How about loans and leases in bank credit at all commercial banks? Growth rate's down to 7.67%. The 6-month rate of change is down to 5.23, and the 3-month rate of change is negative. So again, confirming there is no economic recovery going on in the U.S. economy. How about consumer loans, credit cards? Flat at minus 7.58%. So here we see the middle of July, consumers are not out charging, flatlining. Not good at all. All right, want to come back to our dollar conversation from yesterday, and let me get things loaded up. So there's one thing I didn't talk about was the dollar in relation to consumer price index, because again, what does everybody think consumer prices are going to do? They think they're going to go up. What do I think they're going to do? You got it. I'm bearish CPI. If you could bet on the CPI directly, I probably would be short it, but I can't. And I mean, you can be bearish CPI and be long bonds, so that's the same thing. But you can't trade the CPI directly. So I want to show you in relation to the dollar why we've seen the CPI tick up. So what I did is I put this chart together. It's the trade weighted dollar in blue, and we see consumer price on a year-over-year basis in red. And right at the same point, the dollar shot higher. Why did the dollar shoot higher? Because the Fed did a massive amount of QE and repo loans and dollar swaps. What happened to the consumer price index? On a year-over-year basis, it tanked. Now what's happening with the dollar? Everyone thinks inflation's coming. Dollar's falling. No one wants dollars. Dollars are going to enter a secular bear market. Dollar's going to zero. This is all terrible, terrible, terrible. And look, inflation's going up. And look at this. You can see at the same time, the dollar started to break down. We saw the CPI rise, meaning the next CPI print could show a little bit of inflation, even though the bond market is saying no. But remember, what's the big driver of the dollar right now? The Fed. And so as the Fed continues to do QE, they will start to push the dollar up indirectly. And as the dollar rises and interest rates fall, which we're not seeing here on this chart, what you get is a double tightening effect, because low interest rates are a sign that financial conditions are tight and are tightening. The more they go down, the more they're tightening. It's not until they're low enough to create lending growth, which we just looked at in the H8, and what does it say? There's no lending growth. So financial conditions are tightening, which is why interest rates are headed lower. So now the next thing that needs to happen is the Fed's going to continue doing QE, and we should start to see the dollar rise. And in a fiat-based monetary system, a rising currency tells you financial conditions are tight, and you get a double tightening effect. And that is why I'm bearish CPI. And I think we're going to see real interest rates. There's a question that I'm finally getting to on real interest rates. Why I think real interest rates, which are inflation-adjusted yields, are going sky high. I think that's what's going to drive interest rates down, bond prices up, and I think I'm going to be right about that, so we'll see. All right, let's get into some charts and see what we've got going on here. Of course, you can see. I can't see. There we go. All right. S&P 500 is breaking below its trend line. It's done that before, so bulls need to get on the ball and get this back up early next week. How about Russell 2000? It's breaking its trend line as well. When we look at volatility, it's interesting today that you have stocks down, treasury yields down, and volatility down. It's kind of unusual, but volatility is starting to make a turn higher. It did that before, and it got stuck at this level of 31 on the VIX. Again, I believe you see the VIX get over 31, you see interest rates break down, you're going to see a massive spike in volatility and a big crash in stock prices. I think vol is going to break through this prior peak. I don't think there's anything holding it up. So keep an eye on the VIX. Watch that 31 level, not the VXX. Do not watch 31 on VXX. They're different, and don't trade this thing. I keep it here just to see kind of how it's functioning next to VIX. And a reminder not to touch this thing ever again. How about 5-year Treasury yields? We can see they've broken their trend line, and that would suggest that 5-year Treasury yields are headed to 0. 10-year Treasury yields are flirting with a key support at 0.56%. That means that 10-year Treasury yields, when that breaks, are most likely headed also to 0 or negative. 30-year Treasury yields broke through one of many layers of key support right here at about 1.25%. We broke that today, and now the next big line of support for 30-year is at 1.2, and much lower than 1.2. You've got a retest of the all-time lows coming, and most likely, I think you could even see 30-year hit to 0. I know a lot of people find that odd when they send me emails and say, "Hey Steve, I'm getting ready to refi my house, pretty great deal. What do you think?" And my answer is always the same. I think interest rates are going lower. Not every time I get a reply, but when I do, they're like, "What?" Yeah, I think 30-year mortgage rates are going a lot lower. I'm totally bearish on mortgage rates, because why? We're at record low rates. Are we seeing any growth in lending in the real estate market? No, and that's telling you that interest rates are not low enough. Pretty cool. So continue with my deflationary thesis. All the data is lining up. All the stars are lining up. How about if we go look at TLT, effectively the inverse of the 30-year Treasury yields, and what did we see? We saw this downward triangular pattern. I don't have the bottom drawn in, don't really need it. And what happened? We broke over that, retested the downtrend line, and I said, look, this thing is just going to repeat like it did earlier back in early 2020. It's going to take off. It got into a consolidation pattern just like it did back in February. People said, no way, this isn't going to happen. I said it's going to break through that consolidation pattern. And what happened right in here? Large commercial banks bought over $40 billion of mortgage-backed securities. You don't think that affects the long bond indirectly and long interest rates? It does. And what happened? We hit this resistance level just below 170, and I've said the 170 on TLT, very critical level of resistance. And what happened today? Let's kind of zoom in and take a look. Today, we can see that it broke over that trend line, came below and closed above it, and is sitting, I don't really worry about this after hours stuff, but it's sitting right there poised to break through here. Now keep in mind, on Monday, there's something interesting happening. There's a 30-year QE auction, and the Fed's going to gobble up some more of those bonds. And some of the questions that come in about that is, why is that so bullish for the bond market? Because the Fed is taking supply out of the market. Because when the Fed buys those bonds and they get on the Fed balance sheet, you can't short them, you can't sell them, you can't trade them, they're gone. So what the Fed is doing is reducing the supply. So when you reduce the supply of something, what does price normally do? Goes up. I know, pretty basic stuff, right? But when you think about it and you take it from the perspective that the Fed is removing supply, it makes perfect sense. So we'll see on Monday a QE auction for the 30-year, and at 11 a.m. Pacific, we get the next schedule for the QE auctions. And sometimes they're only a week out, or sometimes they're 2 weeks out. But we'll be curious to see what the Fed's got planned, because remember, Powell said he's going to keep this thing at $120 billion a month. Of course, at the next Fed meeting, we'll find out if that's true or not. But what are the large commercial banks telling us? They think there's going to be more. They're buying up those mortgage-backed securities. Very, very interesting. All right, where are we at here? Let's continue on back up to, we haven't looked at that megaphone pattern on the SPY in a while, and here it is. Still, this should be bullish launch off into the next bull market, but every time it gets over here, it gets reversed, and so we'll be watching this pattern. If it gets back below this megaphone, and again, it suggests that not only are we going to revisit the March lows, we're going through them, and if we get through the bottom end of this pattern, it's saying that there's even further downside risk. Given the state of the U.S. economy, It's a pretty realistic move. How about XLE, which is, of course, mostly ExxonMobil and Chevron, flirting with its topping pattern here, looking like it could break lower in the next week. How about financial stocks? They're flirting with their rising trend line, looking also like a topping pattern. Remember, financial stocks tend to trade inversely, trade in line with treasury yields or inverse treasury bonds. So as yields fall, it tells you that financial stocks should head lower. How about emerging markets? Here's their rising trend line. Looks like a topping pattern here. We break through that. I think we take out those March lows very, very easily on emerging markets. And this is a good indicator of liquidity in the market. And this is validating that liquidity is indeed rolling over. How about, I haven't looked at high yield bonds. Let's take a look at that. And they broke their uptrend line and pretty much continued on. So not slightly higher than when the Fed started purchasing, but not showing a lot going on here. But hey, better than some of the equity charts we looked at. How about we go and look at ExxonMobil? You can see that trend line from XLE. ExxonMobil has broken it. I think we see Exxon easily in the mid to low 20s before all is done. I mean, and Exxon's a great company, pays a nice dividend, and I still think their stock's going to get smashed. How about Boeing? Is flirting kind of toward its upward trend line, looking like a topping pattern. How about PG&E stock kind of coming home here? Everybody wanted to buy PG&E stock around this $8, $9, $10 level, thought it was going to get rich. This is a generational buying opportunity. Well, that generational buying opportunity is still here because they are still trading at 9. But this topping pattern is telling you the PG&E stock's a 0. That this thing's going to nothing. And how about one of my favorite topping patterns that we haven't looked at in a while? AT&T stock. Look at this massive topping pattern. It says that AT&T is just going to get throttled when this breaks. Because why does that happen? Because the way you look at these trend lines is when they break through here, the people that bought here are now in a negative position, so they become sellers, and as they go down, then you get to this location, and these people that bought in here, when it breaks below that, they start selling. These people start selling. The next thing you know, you're all the way back to the beginning of the trend line where buyers are selling, and if you have that much selling, you get a major drop in stock prices. Let's go take a look at the dollar. Everybody's bearish the dollar except Steve, it seems like these days. And the dollar is headed right toward this rising trend line that everyone thinks is going to break. And when it breaks, the dollar is going to 0. Well, hey, guess what? The dollar at 94 has been a massive level of support going back to 2015. So the question is, see, I'm only a fan of rising trend lines when you don't have a very long horizontal pattern like you do here. And so the question is when it gets down to 94. And yes, I will say that I think the dollar finishes down to 94, gets everyone excited about breaking this trend line. And what you find is there's buyers all the way back on the dollar, 2015, 2016, 2018, even in late 2018. My guess is it holds this level because, again, who causes the dollar to go up when they're easing? The Fed. So no, the dollar is not dead. I think you see the dollar reverse right here on top of this supply zone that's split between, say, mid 93 and $94 on DXY. That's what I think is going on. We'll see if I'm right. I suspect I will be. Ooh, look at, man, I haven't looked at this pattern in, look at this topping pattern in 30-year Treasury yields. Broke down. Consolidation pattern, breaking down. Again, I still think 30 years got every shot at going 0, even slightly negative. I really do. All right, let's go back and grab a few questions because I've got a couple of them. And here we go. Hi, Steve. Yes, I agree. The stock market appears to be at absurd levels. Well, based on fundamental values, it's beyond absurd. It makes no sense to me, and I feel like I'm sailing on the Titanic after the iceberg hit. Hey, I'm right there with you. The stock market is listening to the band on the deck. No doubt about that. So my question has to do with gold and its relationship with 10-year Treasury yields. The 10-year real yield, or when you hear real, that means inflation-adjusted yield, appears to perfectly correlate with the inverse chart of gold. I will send you a picture. Now, I generally do not use submitted pictures, but I happen to have a chart of that, as you would expect. So here is the 10-year Treasury yield minus the consumer price index on a year-over-year basis in blue. Here is gold prices inverted. And yes, they look really, really good. In fact, you can see there they are. All right, let's go back to the question and see. I also believe yields will fall. So, okay, so you believe like me that Treasury yields will fall. Can you please discuss this relationship and whether you believe gold will break from this relationship due to the coming deflation? Thank you. All right, well, let's take a look at what I think is going to happen. I believe that you're going to see real yields, which are in blue, go higher. Why is that? Because I think the dollar is going suborbital, massively bullish the dollar. I don't think the Fed is done. I don't think the Fed is close to being done. I think the Fed is going to blow the biggest amount of QE that we've ever seen. In fact, when they do that big last move of QE, we're going to be like, oh man, we're going to think that they've lost their mind. And when they do that, the dollar is suborbital. It's going through the roof. And when the dollar takes off, that is massively bearish for the CPI, just like, let's go back and look at this chart, just like what happened in the great financial crisis. So we'll zoom back and look at this. We saw real yields go straight up, which sent gold straight down because the Fed did this massive QE1, which nobody saw coming or knew what it was. Well, now we know what they're going to do. I just think they're going to do it even bigger. I mean, you say, how can they do that? Look, one, the Fed doesn't have anything else they can do, so that's pretty much it. Number two, it appears to have worked. So what's always the rule of monetary policy? And you don't even have to be a monetary expert. If it worked last time, just do more of it again, and he's going to do more of it. You'll wait and see. I don't know. I'm going to predict it'll be sometime this year, and I'm going to predict it's in the not too distant future. He's going to do it again. He's going to drive the CPI massively negative below Treasury yields, which will stop somewhere near zero, depending on where you're at on the curve. That's how you get a massive spike in real yields. And Steve says gold, stocks, and lots of other things go down. Now after that, then I think real yields go down a lot. Because remember, inflation follows the dollar. You get a big spike in the dollar, people are going to sell it. So we'll see. And guess what? I think interest rates are going to pop. And what does the CPI tend to do? It also follows yields. All right, back to the PowerPoints. Got one more question. Love the show. And I love that you're a viewer. Appreciate you putting in a lot of blood, sweat, and tears to help the rest of us get smarter. And your red and green arrows are absolutely legendary. You're very welcome. And yes, my wife appreciates that comment very much. All right, speaking of getting smarter, yes, let's do it right now. In July 20 episode, you mentioned the 30-year breaks 1.2, the market will puke. And if it pushes the dollar higher, game over, man. Game over. Can you explain further what happens at 1.2? And what would be the scenarios where the dollar would go higher or lower with it? Thanks again and all the best. You're very welcome. Let's take a look at the 30-year yield. There was a reason why we went back up here. I kind of knew that question was coming. So what happens when the 30-year breaks 1.2? Well, what happens is all the people that were selling treasury bonds because they believed interest rates were going to go up, so they short or sold bonds. When yields break down, those who are short are going to need to get bonds or to get out of their, or either to cover their shorts, or they're going to need to exit their short positions, which will cause yields to go down further. Now, the problem, depending on how that person or trader is, money manager is short the market, sometimes you need to buy bonds. And what do you need to buy bonds? You need dollars. Hey, we're in a massive dollar liquidity shortage. So you need dollars, but you're fully invested. So how do you get dollars when you're getting pummeled on your treasury shorts? Well, you got to sell something. So what do you sell? Well, I'll sell stocks because stocks are up, or I'll sell gold because gold's up, or whatever I've been chasing higher. So I sell something. Say I sell stocks, and now I get dollars for my stocks. But what happened? I'm also short volatility. What do you know? So volatility starts to rise, and my volatility shorts start punching me in the face along with my treasury shorts. So now I've got to also go and sell some more stuff, and then the machine starts to unwind. So when everybody is piled into their positions and they don't have any cash, then all of a sudden you get a massive unwind brewing because they're on the wrong side of the market. And who are they on the wrong side of? The Fed. So what causes the dollar to go up, as I already said? The Fed. What's causing interest rates to go down? The Fed. You get it? People say don't fight the Fed. No, you follow the Fed. When the Fed is easing, you follow them. You just do what they're doing. They're buying bonds, you buying bonds. Makes perfect sense. All right, well, that's going to wrap us up until Monday, where I'll see you back for, I think we've got durable goods, new orders coming out on Monday. We'll take a look at how hedge funds positions, and hopefully we'll see what's going on with that 30-year QE auction, what the new schedule is for QE, because we're on the cusp. I mean, look at this chart of TLT. It's telling you, look, everyone that said that I was wrong about the bond market, this is a consolidation pattern that's going to break higher. That's going to be a massive move in the bond market, going to totally unwind the stock market, just like it did back during the great financial crisis. As always, appreciate you taking the time to listen. And the content of this video is provided as educational information only. It's not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation by a security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. The opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.